The proceeding will start shortly. 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 The proceeding will start The proceeding will start shortly. 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 The proceeding will start shortly.
This house, the Grimmond Room.
Of the Treasury Committee to cover evidence on the Bank of England's monetary policy report, and I do appreciate how unusual it is for you to be coming in and giving evidence on the eve of a major fiscal event. So I'm happy to put on record that nothing you say today should be interpreted as any kind of direct signal about the contents of tomorrow's autumn statement. Can I also just put on the record that my cousin is still a senior advisor at the PRA, and I feel I need to know
very long-standing colleague
for the record.
Yes.
Can I introduce the witnesses, starting with you, Governor?
Andrew Bailey, Governor of the Bank of England.
Catherine?
Catherine Mann, External Member, Monetary Policy Committee.
Ben Broadbent, Deputy Governor for Monetary Policy.
Swati?
Swati Dhingra, External Member, Monetary Policy Committee.
Welcome, and I think this is your first session, Swati, isn't it? So very good to see you. So, Governor, 11.1% inflation, and you will be aware that members of this committee have been flagging long before Russia invaded Ukraine that there were potential inflationary upside risks in the economy. Your goal is 2%. What's gone wrong with your forecast modelling?
Well, if you don't mind, let's go back to COVID for a moment and work forwards. So obviously in two and a half years ago now, the economy was hit by a huge shock in terms of the pandemic. And I think it was, it was obviously necessary and appropriate that monetary policy responded to that. What we've had since then, I think, is a series of supply shocks, essentially, in the UK economy, which have reduced particularly when you look at the labour force, reduced the capacity and the supply capacity of the UK economy relative to demand. And to put those shocks in sort of chronological order, there was a what we tend to call a supply chain shock in the recovery from COVID. And that's a global shock, actually, because it reflected goods and services demand and stretched supply chains, particularly involving China. And just it's useful to say, I think we are now seeing the evidence that shock is coming off. The next shock I would highlight is in many ways is the big one, which, as you said, is Russia-Ukraine, which has had a very big impact in two areas, I would say, energy and food. And the third one is a domestic shock, which is the tightness of the UK labour market and the fact that the UK labour force has reduced in size relative to the pre-COVID number. And I think I'm right in saying our colleague Jonathan Haskell made a speech where he covered this, I think, last week and had a very interesting chart which shows that the UK is the only OECD country which showing this pattern of labour force shock. Now, to come back to your question, I think the one that we look back on is, and I asked the question, if we go back a year now, actually, how easy would it have been to forecast that pattern of UK labour supply? Because in many ways, I think Russia-Ukraine, if you don't mind me saying so, it was very hard even a year ago to forecast what was going to happen there. Obviously, a year ago, there was a question over the supply chain shock. Was it going to be transient or not? I would say, taken on its own, the evidence is that it is now wearing off, actually. The problem is we've had this sequence of shocks. And if I can go back to the labour force shock for a moment, I think it was very hard a year ago. I mean, it dominated our thinking a year ago. As the furlough scheme came to an end, 1 million jobs were furloughed right to the end of the scheme. It was around about this time last year when we were beginning to get the evidence as to what was going to happen to the labour market. as that scheme ended, and there was a real uncertainty, and you can see this in not just our forecasts, in all the outside forecasts as well. Was it going to lead to an upturn in unemployment, as frankly nearly all forecasts said it would? We were actually at the low end of that distribution. Of course, it didn't. And one of the reasons it didn't was because of this shrinkage of the labour force. Now, I'm happy, I think it's happened. I'm sure a lot of people will spend a lot of time trying to work out what we could have foreseen about that at this time last year. But I think it was a very difficult call to make this time last year. Now, working forwards,
there was nothing wrong with your model.
No. Let me say no. I mean, look, with the benefit of hindsight, obviously there were things that would have been different. The one I asked myself, and I've said this in speeches, the question about is the labour force, because I don't think we could foresee that Russia was going to invade Ukraine. I don't really think that's.
I agree. We should put that to one side.
Yeah.
And I think we need to focus on these supply chain and domestic factors, which I think you're now acknowledging, Governor, you did miscalculate the potential risks when furlough came to an end. I think that's what I'm hearing you say.
Take both of those, perfectly reasonable. So I think, and by the way, I think one of the challenges we have here is that, the view that if you take an individual single supply shock, that they work their way through, and you don't necessarily, respond to the first round sort of effects of them. It's the sort of what might happen thereafter. That if we had only had one supply shock, which in the period when we were initially recovering from COVID, I think was a reasonable assumption as the supply chain shock took effect. I think the response to that would be very different from the situation we now have, where we've had this a sequence of supply shocks with no breaks in between. This is one of the challenges I think central banks around the world face, frankly, that we've had a sequence of supply shocks, which you couldn't predict, I think, at the time that we were going to get this sequence. But take the two ones you mentioned, the supply chain shock.
But Governor, do you not acknowledge that having very, very loose monetary policy and very, very loose fiscal policy at the time, and a situation where you had your foot on the floor with the quantitative tightening program, that the quantitative easing program, we'll get to quantitative tightening later on, that the risks in that scenario were for inflation to take hold and for it to become the kind of wage price spiral that we are currently seeing our constituents suffer from.
And I totally understand that, but can I respond by saying that would have required us to tighten monetary policy at the height of the pandemic because of the transmission mechanism. Now, I don't think that, put like that, I'm afraid I don't think that is a very plausible thing.
0.1%, I mean...
But in the middle of a pandemic, when it was having the economic effects that it was having, I don't think that, I really don't think that's a reasonable thing to have done based on what we knew at the time.
I'm going to turn to Catherine, if I may, because Catherine, you've been very much sort of at the hawkish end of the spectrum in terms of the Monetary Policy Committee, and I know you've been calling for a higher bank rate increase than your colleagues, I think 4 times now. Mm-hmm. So how do you respond to this criticism, or are you happy with what the Governor is saying, that there was absolutely no way this terrible wage price spiral which we're experiencing now in the UK could have been avoided?
Can I just say, I didn't say that, because I'm happy to come back later, but I didn't get to the end of the point on the labour market. But let's come back to that. I don't want to interrupt.
We will come back to the labour market,
Okay. Well, first, I'm very delighted to be here with you in person, so that's good. Now, you have noted that my votes have tended to be more forceful than that reached by the committee, and the foundation of that is twofold. One is I have been particularly attuned to data on price expectations of firms, households, and in financial markets. So I put a very high weight on price expectations. And that's one way of trying to gauge prospects going forward. I also put a very high weight on research that has tended to find that under conditions of inflation uncertainties, in other words, you don't exactly know how it's going to proceed going forward, that front-loaded policy tightening is more likely to achieve an outcome that is better controlling of inflation. With all that said, however, The shocks that are external shocks to the UK economy, specifically the energy shock and the global goods shock, these continue to dominate the numbers, but what we care about is the extent to which they become embedded. And, looking at where we are now, we have taken, over our last few meetings, a much more aggressive approach as this embeddedness has become more apparent.
But Catherine,
Yeah.
Thank you for that. Are you saying that if the whole committee had agreed with you and that you had moved earlier and faster, that the overall picture on inflation now would be better? We wouldn't be suffering from 11.1% inflation today.
I think we have to go back to the magnitude of the energy shock and the way in which it has been calculated.
Last time we had from the governor, I think, said that 80% of inflation was coming from the invasion shock, and the remaining 20% you felt was more widespread. Does that continue to be your assessment, Catherine?
I think that the general view is that there is more of these shocks have become embedded into the actual price and wage setting in the economy and continue to support a higher wage and price expectations. And in that regard, taking more forceful action earlier on, as I say, the research identifies a front-loaded policy strategy as potentially having a superior outcome with regard to inflation.
That's really interesting, and we'd be really interested to see that research, because clearly that's different from what has actually happened. And to go back to the governor in terms of the quantitative easing point, Hugh Pill last week told the House of Lords Economic Affairs Committee that the previous rounds of quantitative easing during the pandemic might have been a contributory factor to this upsurge in inflation. Is that what your assessment would suggest now?
Well, I think, if you don't mind saying so, what Hugh actually prefaced his comment by saying is that it's always possible, with the benefit of hindsight, to come up with a different path of monetary policy.
None of this could have been seen.
No, hang on. Let me finish. He then made the point that I just made about the scale of the COVID shock. And he also made a point that, yes, QE did contribute, because, of course, that's what it was designed to do. It is a policy loosening tool in that sense. But he made the point, and I think it's consistent with what both Catherine and I have been saying about the shocks that we're experiencing, that it was not a very big contribution. And again, you have to bear in mind the hindsight point in which he made that comment. He was doing it deliberately with the benefit of hindsight, which, as he said at the time, of course, we don't have when we set policy.
Go back to the labour market, as I promised we would, and then I do want to ask Ben a quick question before moving on to colleagues. To go back to the labour market point, it's clear now, isn't it, that we're in a wage price spiral, that there is a lot of wage pressure out there. And I just wondered if you could share with us, Governor, how much you're going to be increasing pay at the Bank of England this year.
Well, we haven't settled our pay round yet. We're still in the process of doing it, so I can't give you that number actually. What are you
proposing?
Well, you can observe that total economy pay is somewhat over 6%.
You're going to pay 6% more
no, I don't
to
think
your
we'll
employees?
No,
okay.
No, we're not be going there. I would also make the point that the mix of pay and these settlements has changed, and we pick this up when we go around the country talking to businesses, that there are more businesses talking about using one-off payments rather than permanent pay rises, and also directing their use of those settlements, of those pay components towards the low paid. And that is, I can tell you, part of our approach towards what we're doing. We want to ensure that our lower paid staff actually get a larger share of the pay that we're offering this year, because I think that's the fair way to do it in the context of the situation we find ourselves in.
Will you be taking a pay rise this year?
I'm not going to take a pay rise. I mean, it's not for me to decide, but I'm not going to. If I were offered one, I will not accept it, and I will politely decline, as I have before.
Thank you, Governor. And then just quickly to Ben, were these upside risks to inflation, and particularly with quantitative easing as well, were those subjects that the Monetary Policy Committee was discussing long before the invasion of Ukraine?
Yeah, of course. And we do every time we meet. That's what we do.
Yeah.
Can I make a couple of other points in relation to the earlier questions? Just to ram home a couple of points about the taking care with hindsight. So just after that QE decision, the last one at the end of 2020, if you look at the consensus forecast, which is an average of, 2025, the main forecasters of the UK economy, what they expected inflation to average during the course of this year, 2022, so between 1 and 2 years later, the figure was exactly 2%. In financial markets, where they spend a great deal of time as well, just like us, thinking what inflation will be, the figure for RPI inflation priced into financial markets at that time was just over 3. So consistent, again, given the spread between the two, with a CPI inflation rate of 2. That is the context in which that was just after the QE decision. So, it's fine to say after the event, well, this happened, that happened. But the fact that something happened that was not forecast doesn't mean the forecast was wrong. It means that we live in a highly uncertain world. And we've had these extraordinary shocks, bigger energy price shocks even in the 70s, not just energy but food, not just energy and food, but core goods after the pandemic as well. So I think one must be very, very careful to put yourself in the position at the time. And of course, every time we meet, we discuss both upside and downside risks. One hopes that the forecast is not, and the forecast is never meant to be a prediction of what will happen.
Honestly,
it is precisely the point where you think, well, the risks of being wrong on one side are more or less the same the risks of being wrong on the other. That's what a forecast is.
I wouldn't be asking these questions if I hadn't in real time been asking about some of the inflation
risks. The relevant point is not a year ago, it's 2 years ago. Given the lags in monetary policy, it's 2 years ago.
Yeah.
And of course, and I think that it was, if I had to think back and say, what could we have known better? Certainly not Russia-Ukraine, not even the development of the labour market. As the Governor pointed out, at the time the furlough scheme coming to end, we were right at one end of that forecast. We were at the more hawkish end on the labour market forecast. And the UK has had these exceptional developments, quite unlike any other country. So I don't think that either is the biggest contributor to inflation. I think it's relatively minor, and B, I don't think it was forecastable. The one area where I think all central banks, indeed all economic forecasters, given what I said about those numbers earlier, might have picked up earlier were the inflationary effects of the pandemic via supply chains, where we did begin to see evidence, I would say, in early 2021. However, as it happens, that particular source of inflation, the direct effects of it at least, do seem to have peaked now. So we're seeing some evidence that core goods price inflation is declining, that shipping costs, computer chip prices, all the things that were pushed up dramatically in the first half of 2021, that those things are beginning to ease off. So yes, at any one time, you can find some people forecasting higher inflation than us and some people forecasting lower inflation than us. And I think the relevant point is not a year ago. The relevant point, given the lags of monetary policy, is 2 years ago.
Yeah.
And I'm giving you the consensus forecast at the time.
And I sort of was worried about it, as the record will show. But in terms of our constituents who are all now suffering from this terrible, terrible inflation, can they feel confident that with 3% as the base rate, that you are going to be able to bring inflation back within the range that you are independently there to target? And Governor, can I just also ask, as you answer that question, in your previous evidence to us, you've implied that you always do look at what is priced into the market. And we've just heard that from the Deputy Governor now. But in your latest forward guidance to the market, you gave a very strong steer that you thought the market was incorrectly pricing in forward interest rates. Can you talk us through your logic there?
Yeah, well, let me do that in two parts, so sort of two questions in there, really. So let me start with what we said if you don't mind. And we said, should the economy evolve broadly in line with our latest projections, that's the one we published very recently, further increases in bank rate may be required for a sustainable return of inflation to target, albeit to a peak lower than priced into markets. That's the key, I think, sentence to which both parts of your question refer. So let me take the first part. We think that, other things equal, the path of these shocks will lead to a once we get through this winter, because of the way the gas price effects are going to work through this winter, that there should be quite a pronounced fall in inflation thereafter, and our forecast brings it back to target and actually takes it below target, actually to zero in year 3, and I'll come back to that point because it's key for the second question. Now, however, so you might say, well, why are you raising interest rates in that case? And however, the other things equal is that we've also got the largest upside risk to inflation in the distribution of that chart in the history of the MPC, 25 years. It's about 0.5%. And the reason we've got that, we don't construct the risks, I should say, bottom up. We don't do it's a bit of this and a bit of that. We tend to do it top down and then sort of attribute the broad story. And it's the one we've been talking about already. For me, we can all probably take slightly different views on how this works, by the way. It's predominantly the labour market and the risk of price setting and wage setting effects coming through from what is just a very tight labour market. Because although, and I was around the north of England last week, employers are now beginning to say that they are seeing some reduction in competition for hiring. It is still a very tight labour market, as yesterday's labour market statistics demonstrated. I mean, it's a very tight labour market. So the reason that we said it is likely, that we will be, increasing interest rates further is that risk, notwithstanding the fact that the central sort of case, if you like, the central projection has inflation coming down rapidly. And by the way, the main reason inflation comes down rapidly in that case is sort of arithmetic, really, which is that as the annual effects of the energy price rises come out, inflation comes down quite quickly. That, of course, presumes that energy prices don't go up further. We can come back to that if you like, because, obviously there is some risk there, but that's the basis of the projection. Now, let me come on to the second part, which is the markets. We condition our forecast on the market curve of interest rates. Now, just to illustrate this in terms of what the market has thought is going to be the peak of our interest rate rise cycle. So back in August, beginning of August, when we published the August Monetary Policy Report, the market was predicting 3% as the peak, which obviously we're now at. By the end of September, that number had gone up to 6.2%. Now we'll probably come back to the reasons why that happened. It's due to a lot of the things that were obviously going on. By the time we did the forecast for the November MPR, and we cut the forecast off sort of in later part of October, that number was down to 5.2. Today it's 4.6. We had 5.2 in there for the forecast. And as I said, when we look at the profile of inflation that generates, it brings it down to 0 in the third year. It's a bit below target at the end of the second year. And so our view was that profile, in our view, had a curve that was higher than was consistent with our view on the sort of the likely path. Now, you may want to say, well, yeah, it's down to 4.6 now. What do you think about that? We don't have a precise set of numbers. It's not that we have a precise set of numbers. It's clearly lower than it was when we did the forecast. My final point I'll make on this, we don't push against markets lightly. It's not something we rarely do it, frankly, but we felt that this was we knew the story behind why there was. Let's be honest, there was something of a UK risk premium built into the markets, and I gave that 3, 6.2, 5.2, 4.6 profile. And we felt that was too high a profile, and it wasn't consistent with what we think is the most likely thing we'll do. So that's why we did it.
How much is the UK risk premium today?
Well, hard to tell. I would say in the markets, most of it has come out. If you look at,
it's not 0 though.
It's not probably back to 0, but if you look at one way of looking at this is to look at the evolution of the UK curve, the euro area curve, and the US curve since the beginning of August. And I think we've published this chart actually, and you can see the UK premium. You can see that they have come
what
back
is it
to
today?
They're fairly aligned again today in terms of tracking the movement, not the levels. Levels are different, but the movement since the beginning of August.
Thank you, Governor.
So a lot of it has come out, in other words.
I'm going to hand over to Anthony. Anthony.
Thank you, Chair. So my initial questions are going to be about the economic outlook. You predicted in the Monetary Policy Report a recession which was not as deep, I think, as previous recessions we've had in the latter half of the 20th century, but possibly longer. I was just wondering how much uncertainty there was around that, and there's obviously lots of speculation about how long and how deep it's going to be, but if you could just describe what you think the sort of outer limits are, and is there any chance we're going to avoid a recession?
Yeah, I'm sure my colleagues want to come in, but I think it goes back to the point of the previous question, actually, that in part the uncertainty around this reflects the impact of the tightening of financial conditions that we saw between the sort of the August Monetary Policy Report and the November Monetary Policy Report. And that's why we actually, in the presentation of the November Monetary Policy Report, put rather more emphasis on the other forecast we produce, which is the so-called constant rate forecast, than we normally do. Not because, I mean, very clear, not because we don't, and I've read the language out a few minutes ago, don't think that rates are going to, most likely go up again, but because it's a useful, if you like, sort of set of rails, if you like, to sort of see the sort of the margin it generates. And just to give you the story on the recession, I can do that in terms of the level, i.e. the shift in the level of GDP, and it's I think peak to trough for the market profile it was about 3%, so negative 3% that is, and for the constant rate it was just
GDP.
Yeah, it was, and peak to trough for the constant rate it's just under 2%. So now any recession is a bad recession, don't get me wrong. As you said, they're not deep recessions by historical standards, and the constant rate one is obviously even shallower. But that gives you a sense, I hope, of the sort of at least two rails that you can put in to sort of make a judgment on, help to make a judgment on this.
Compared to previous recessions, as I understand your graphs, it's actually going to be quite, you're predicting it'll be quite a prolonged recession, more than most. Why it'll go through to 23, 24. Why do you think it'll be so prolonged? I think Ben's keen to get in.
Well, the only thing I was going to say on that is, well, one, to emphasise the point that Andrew just made, which is that remember always the interest rate curve on which we're conditioning these forecasts. So that was significantly higher even a couple of weeks ago than it is today. The other thing is that by the time, well, the other general point is there is generally a huge amount of uncertainty about this forecast, and in particular, even on the central profile, the last 2 or 3 quarters of that projected decline in GDP, length of the recession, are pretty small. So it wouldn't take much of a tilt to shave a couple of quarters off the projected length of the recession. So I would not, stand squarely behind the length and say this will definitely happen. I think it could quite easily turn out to be a little bit shorter, a little bit longer. On that constant rate forecast, there's still a recession in the forecast. And I should say that a lot of the weakness, there's some underlying weakness in supply. The trend growth rate against which we're judging things is not itself very high. But also the effects of these energy and food price shocks. And in general, the rise in import prices, which lie behind the hit to real incomes, are already taking a big toll. And one thing I might point out with respect to the earlier conversation is that what is making people worse off, that spread between wages and price growth, wage growth and price inflation, is directly the impact of these higher import prices, and it is inescapable. And that is what is driving the weakness right now. As you go through the forecast, certainly the one we did in November, which had further steep rises in interest rates, more of the weakness is due to the tightness of financial conditions and indeed monetary tightening. But what we're getting right now, and we could well be in another quarter of contraction right now, is, I think, a result of something that has already happened. So in that sense, obviously one's more certain about the near term than the medium term. But further out, there's a lot of uncertainty, and including about the length, I would say. Sorry, I don't know if anyone else, Swati, wants to say anything, or Catherine.
No, I think, basically, what we buy from abroad costs a lot more.
We're poorer.
And that makes us poorer.
Yeah.
And monetary policy can't offset that.
That's a point I've made to many people.
It doesn't make it any better, but
It's difficult to deal with. Does the Ben, you talked, you sort of touched on some of the distribution impact there. Are there particular groups of people who you think in society you think will bear the brunt of the recession? Is it going to be more difficult for people who are?
Well, I mean,
because middle income people have built up a lot of savings, they've probably got a bit more cushion.
yeah, the
there.
better end has. And traditionally, I say traditionally, it's not the right word. Historically, on average, recessions are regressive. It is the less well-paid that are more likely to lose jobs in a downturn. And of course, these huge rises in import prices happen to be in areas which form a larger part of the consumption basket for less well-off people, energy and food. So that's making a difference as well. I look at the numbers for producer prices this morning, which come out alongside the consumer price numbers. The number for imported food prices, I think, is up 30% year on year. It gives you some idea of the pressures that are coming through. The only thing that goes against that is maybe there are differences in the distribution of wage growth, and some of those may be stronger at the lower end. But you're right that there are some, in general, recessions are regressive, and the particular rises we're getting in import
those
prices
are vulnerable
are as
going to
well.
be particularly badly hit.
I mean, just to give you an example, based on this morning's inflation number, our staff calculated, based on the consumption baskets, I think this is taking the income distribution in deciles, for the 9th decile, which is top at 1, inflation rate was 10.5, but for the 2nd decile, that's the bottom at 1, it was 11.9. That shows you that.
and keep in mind as well, the people at the top end of the distribution aren't spending their full
They've got a
salary.
lot more.
So
They've got a lot
inflation
more,
is not affecting these full. Their full.
They're just
One
going to
more-
save less each month.
Sorry, I'll add one more demographic group to that, which is younger individuals. Typically, the ones who enter the labor market in a recessionary environment are the ones who end up with perpetually lower wages. So I think that risk is pretty strong as well here.
I had a question for you, Sweetie. That you've been at the dovish end of rate rises. You're in a minority voting for a 0.5% increase rather than 0.75 last time round and in earlier times. Why do you think you've got a different judgment about inflation expectations than others? Or why are you more optimistic or less pessimistic?
So let me actually just start with reiterating the point about I am a trade economist and I take that very seriously in terms of what the terms of trade shock implies. It's going to show up as us being poorer, either in terms of lower profits, lower wages, real wages, or higher prices, which means the consumers end up suffering. So I think that's just a reality which we're going to have to face up to, and that we are just poorer and there's not any kind of solution to that from monetary policy. On the other element, which is, should I have voted higher or lower? This I can explain to you what determined why I voted for 25 basis points in the first case and 50 basis points in the second case. The main point was that by November it was quite apparent that not only had the economy slowed, but it was already in negative territory. So, and this is one way of thinking about the constant rate projection, which the governor has emphasized, as well as the market expected yield, the curve, is that you could think of getting into a much deeper, much longer recession if rates continue to rise, because there's already about a fairly sizable chunk of the previous rate rises that have got to take effect in terms of what they do to GDP. There's also the inflationary impacts which have not fully manifested themselves. So in that sense, at this point now, there is a sense in which, with rates being higher than where we stood, say, a year ago, that there is a risk of over-tightening. And that's the thing I'm worried about at this point, though I completely take the view that, yes, inflation expectations are high. Quite often they're very influenced by what the spot inflation rate is. So in that sense, they're not simply a measure of inflation expectations. They take into account what is the salient thing that people are seeing. Energy prices, of course, is a very salient thing. So those were my concerns, and I didn't find enough of a reason to have a very, very forceful action, because some of the base effects were still there in the September numbers. there was then subsequently some more increase in services producer price indices, even though energy prices were not rising, and that made me move a bit to the higher end of the spectrum then.
Can I ask finally just about international comparisons? Obviously various journalists have pointed out that we're the only G7 country where the economy is currently contracting, and yet there are also forecasts that the government repeats, I think, from the IMF that we're going to be the fastest growing economy in the G7 this year, or at least that was a projection recently. I'm just wondering how you see us comparing internationally, and whether our economic outlook is more troubling than other comparator countries, and if so, why?
Well, we may all have different different particular indicators we sort of look at for this. I'll tell you mine, and that's the level of UK GDP now versus the pre-COVID level compared to other economies. I'm afraid it's not a good story I'm about to tell you. So the UK level is, I think, minus 0.7. So in other words, the economy is smaller than it was at the end of 2019 in terms of GDP. The euro area is plus 2.1, and the US on the latest number, which is just kind of, is plus 4.2. Now,
what accounts for that difference? That's a dramatic difference.
It is a dramatic difference. Well, I think there's probably quite a few things that account for it. The approach that's been taken towards energy prices, fiscal support. The US has had a lot of fiscal support. I mean, the US is in a very different position in terms of the economy. So there's probably quite a lot of things contributing to it, but it's a pretty. I mean, for me, it's a pretty striking.
Including as Andrew said earlier, the labour force.
Labour force is
part of it. I mean, I have to say, if you look at the higher frequency indicators, things like the PMI surveys, which are good measures of growth, what stands out is the US more than us. I mean, the European trends look very similar to those in the UK because the big shock has been gas prices, and the US has escaped that.
Wage dynamics are different, though, also between the UK and the euro area. The wage dynamics are different. But, I mean, it does come back to the labor force participation in the UK is a dramatic outlier compared to all of the other advanced economies. And this is a puzzle. It's a puzzle because, in principle, with higher wages being offered, even if not as high as price inflation, that would tend to bring people back into work. Similarly, if you look at it through the other lens, is if people are not in the labor force and are not working, how are they managing, given the inflationary environment of their pocketbook? And that is a very significant puzzle.
I'd love to ask some questions, but I'm out of time.
Thanks, Anthony. Rishnara.
Well, thank you very much. So I've got questions around the future path of inflation, but I just wanted to ask a couple of follow-up questions in relation to the point about a prolonged recession that I think, Ben, you were talking about. So do I take it from what you're saying is that we should expect this recession to be prolonged and deep, or is it going to be shallow? The Chancellor's talked about shallower. He's trying to have a softer landing. It sounds like it could be something quite different from what you're saying.
I mean, as Anthony described, the central forecast, at least, is slightly shallower than others and slightly longer.
Right.
But, I mean, how confident one can be of either of those, I'm not sure. If you look at our central part, I mean, as I say, certainly the length, I don't think one should emphasise too much, because the profile is so almost flat. It's just declining in the latter part of that projected recession. On the other hand, it seems likely, we don't know, we won't find out for 3 months or something, that we could well have had already by the end of this year 2 quarters of negative growth. I mean, what matters for us in the projections is more, the growth relative to the trend in the economy. Mm-hmm. And by those standards, it's not particularly, in the forecast at least, that deeper recession.
Okay, so if it's not that deeper recession, in terms of unemployment, for instance, could you talk us through what you expect unemployment levels to be? I mean, we talked about tight labour market, but there will be some unemployment. How bad is it likely to be, or is it likely to be less bad than before? No, that's still bad.
Well, again, one has to take care to think, looking at a forecast conditioned on the steep rises in interest rates that were there at the time of the November report. And you've seen the unemployment numbers, they go to 6. In the central forecast, could be higher, could be lower. And I can't remember what the peak is in the constant rate.
5.
Yeah,
5.1.
So, there's some rise, but it's not, say, the rise in the early 90s recession where unemployment went up to a lot higher.
I think there's also, if you don't mind coming in, I think there's also an interesting question here, because certainly, I speak for myself when I go around with our regional agents, labour market is number one story firms want to talk about, and has been for a while. I think still firms, and I would say I was in North East and the North West yet last week, I think firms are still talking in terms of it is so difficult to hire labour now that we are not going to we're not going to get rid of them, lightly, as it were. There'll be a tendency to want to retain labour because of the difficulty of actually getting them.
So that will make it less. That will make it less of an issue in terms of migration, presumably. Because
it could make the rise of it could push down on the
demand
rise of unemployment. That's the point. It would then probably transfer into somewhat lower profits actually for firms.
Sorry, say that again?
Well, if you think about the labour share and the profit share, it would sort of transfer some of that through the recession away from towards the labour share.
And then turning to sort of the things you were saying about the UK risk premium, there are quite a few euphemisms being used about the period, what happened between end of August and beginning of October. And the numbers you were talking about in terms of interest, 3% end of August, and then up by 6.7, and then
6.2, yeah.
Sorry, 6.2, and then now on to 4.6. So just to try and uncover some of this, can you just tell us what the UK specific elements were in terms of interest rates, risk premium? But also, you mentioned 20% around inflation, and the strategy for the approach of upward trend of interest rates. That's not going to resolve the issue about the 80%. So, how effective are those tools, do you think, in terms of increases in interest rates? So there's two sets of questions, if you like. The first one about
80-20. So as we have a chart in the report which attempts to break down the sort of contributors to the market interest rate profile between global shocks and UK shocks, and you can see really up until later part of into August it was all global.
Yeah.
And then there's a UK contribution comes in quite pronounced way, but it is actually
during the mini budget period, just to be clear.
During that period, that's now coming off, and I say I think.
So, what amount was it that you can attribute to that UK specific element connected to that event?
It's about at the maximum. It was about sort of 170, 180 basis points. According to this, all these decompositions, of course, are stylized. I mean, they're based on models, so you have to understand. It's not a precise. Science. And by the way, when we did the 3% and it's 4.6 now, of course, as I mentioned earlier in a question, if you look at the euro area in the US, they've all gone up. So it's not that we've still got 1.6% of UK risk premium left in the. It's gone up for the euro and the US.
But sure. But taking that into account, what's the UK element?
What now?
Oh,
it's coming down. I mean, we don't have an up-to-date decomposition of this sort, but I would say now, in terms of, as I was saying to the earlier question, in terms of the differential between our movement and the US and the euro area, it's come down a lot. It's not.
I mean, one other way to judge this, look at the currency.
Yeah.
And at the time of the August report, I think sterling dollar was, say, 119. A dollar was worth, a pound was worth $1.19. At the low, that fell to what, 103 or something? And it's now 119 again.
119 this morning,
So the cost of imports during that time, given
that was
Not too many come in. I mean,
Sorry?
that's a really short period of time.
They're
That would be
typically on
contracts would have been made.
Yeah.
But 20% down from the beginning of the year does translate into an inflationary effect.
Yeah.
And 40% of food is imported, for example. And so you can see
Exactly.
how you have a depreciation passing through that channel.
If I could also add, I mean, we've talked about prices and markets here. I mean, there was a second element to this, that we had very, very illiquid markets and very volatile markets in the sense that they were not trading well.
Okay, I'm just going to you mentioned a list of earlier to the chair's question, a sequence of shocks, COVID, supply chain shocks in Russia and so on. I'm going to bring the B word in again because we haven't talked about it for a long time, and we all know that it's 4.5% before the Brexiteers join the committee. I think there are a few, I'm sure, who'll join us. But the point is that with a 4% hit on GDP in the long term, I wonder if you can comment on that. The former MPC member Michael Saunders said this week, if we hadn't had Brexit, we probably wouldn't be looking at having an austerity budget this week. What do you make of these comments? And do you agree that there's self-harm that's been done to our economy, and these shocks that we've had since have made us more vulnerable than other economies?
Yeah, I mean, I think, and we've talked about this a lot of times before. I mean, I think the bank's assessment, and we use this in the forecasts on the Brexit impact, really hasn't changed actually since the sort of work that was done.
Doesn't it in effect compound the problem?
Well, I think I was going to
well.
follow up and say, I mean, this work, I think Ben will remember better than I do, because I wasn't at the bank at the time, but this was done pretty soon after the referendum. It essentially assumes that there is a long-run downshift in the level of productivity. I think of around, it's a bit over 3%, and that at least two of those comes sort of fairly well forward in the time frame. And I think it's fair to say I don't think anything we've seen so far changes our view on that. We haven't changed our view on that so far. So there is an effect in it. That's what I'm saying. Yes, there is an effect. It's not one that, as I say, we've not been surprised by that. I would also add that, I mean, I think it's for Michael to obviously take his own view.
He's a liberated man now, clearly. Carry on.
You said it. I've always, my approach has always been that, as a public official, I'm neutral on Brexit, per se, but I'm not neutral in saying these are what we think are the most likely economic effects of it. But you're a great expert on this subject.
I can comment on that, and clearly I've written a lot about it, so I'm not going to talk about the political choice that was made. I'm going to talk about the economic impact.
But the implications is what I'm interested in.
So it's undeniable now that we're seeing much bigger slowdown in trade in the UK compared to the rest of the world. That's showing up despite the statistics having been much worse than they used to be, there being a discontinuity, but people have tried to do various ways of trying to correct for those things. There's also the services export side, which we don't have very much contaminated statistics for, so I can say that much more confidently, that there again we're seeing a really strong stagnation. So we're definitely performing below trend in terms of the exports numbers, in terms of the imports, even probably a bit bigger than that.
Yep.
My own work shows that the simple way of thinking about what Brexit's done to the economy is that in the period that happened after the referendum, there was the very, very sort of powerful, the biggest depreciation that any of the world's four major economies have seen overnight, that contributed to increasing prices, reduced wages, and I'm not talking simply through real wages, but also through nominal wages. We think that number is about 2.6% below the trend that real wages would have been on. After that came, sort of soon afterwards and before the TCA happened, came the effects from the uncertainty that was unleashed, which basically translates into reduced business investment. I'm less certain of the FDI effects. Those tend to be very lumpy things. Then what's happening now, we're starting to now see the trade numbers react to the Brexit, the actual TCA impact. And that's what I mentioned in the beginning, that we're definitely underperforming compared to our peers, both in terms of what we're sending to the EU, as well as in terms of what we're sending to the rest of the world.
Okay.
I'd like to add on to this because I look at a lot of firm level data, and the small firms are the ones that are most damaged because the cost of the paperwork and so forth is a barrier. It's not just small firms in the UK who want to export, but it is also small firms in Europe who were suppliers and provided competition in the UK market. So there is an inflationary effect coming through the competition channel.
And do you have a sense of what the amount is, the inflationary effect amount is relating to trade with the EU and friction versus, in both directions?
I'm not going to hazard a guess on that.
I can talk about the food price effects that some excellent students at LSE have done this work, that about 6% of inflation in food prices, 6% is the number which is higher than the rest of the world, so as a result of the Brexit impact.
Okay, that's really interesting.
Right now, the inflation rates are pretty close.
Sorry?
Right now, the inflation rates are pretty close.
Yeah.
We had 11.1 in October, the euro area is 10.7. So the timing of these effects is hard to judge. I mean, as Andrew said, we've seen no reason to row back from the estimate we had on the overall impact on real GDP, which is what really matters for real incomes. That we made.
Just going back to Michael Saunders, we probably wouldn't be looking at an austerity budget this week. You can't comment on that. Fair enough. Just one last question, which is about peak inflation. Have we reached it? I mean, you talk about it going down middle of next year. Should we expect it to continue to rise in the coming, given where we are in the ONS data?
I think our forecasts are pretty much flat around this level for another 3 months. Maybe it edges down a bit in the first quarter in the central projection. But it's really when these base effects on energy kick in the spring that you start to see the material.
I mean, the energy effect, of course, is now capped until actively April. I mean, I think looking at this morning's number, and going back to what Smarty was saying actually as well, I mean, in terms of food is the area I think particularly watchful, because certainly looking at this morning's number, it actually wasn't much higher than we expected. I mean, we've said consistently it was going to be around 11%. Frankly, it was about 0.15 above where we thought it would be. But looking at the components, food was the other thing that contributed.
I'm going to stop there.
Thank you so much, Rishanara Siobhan.
Thank you very much. I just want to look at the impact of recent developments on the housing and mortgage market, particularly the impact of the sharp increase in mortgage rates. You note in the monetary policy report that there are particular uncertainties around the impact on consumption of recent and prospective developments in the mortgage market. Can you tell us more about the nature of these uncertainties and how they fed into your latest decision on the bank rate?
Well, I'd pick out a couple of things on that in terms of, one's a bit longer term and the other's rather short term. Longer term, I mean, we have seen quite a switch. This is the last decade. We've seen quite a switch in the nature of the mortgage market in this country towards fixed rate mortgages. So, I think about 80% of UK mortgages are now fixed rate and about 20% is floating rate. I think if you go back 10 years, it was certainly in the 60s, I think, 60, just a bit above 65. So it has shifted. And that actually was, that was a progressive shift over time. Now, actually, having said that, I think our staff certainly, when they do calculations, suggest that by the end of next year, I think something like 50% of mortgages will have repriced. So that's the variable rates, which of course will naturally reprice, and then those fixed rate mortgages that are coming up for new mortgages, as new contracts. So, that affects a bit the transmission, but it's the mortgage market is still an important part of the transmission system. Now, that of course will, as a result, we have to be very, very sort of frank here, that will of course increase the mortgage burden for households, for those households that are either on variable rate or coming up to a fixed reset. The scale for the fixed reset, of course, depends on what the pre-existing rate is compared to the current rate. Now, coming to the short term, and this comes back to what we were talking about, the market movements over recent times. One of the consequences of the shift to fixed rate mortgages is that fixed rate mortgages price off the curve, the market curve. They're not priced directly off our our official rate, whereas variable rate mortgages are much more closely tied to our official rate. They price off the market curve. What we saw during September, early October, again, because of the effects on the curve and the instability of the curve, was that pricing was very difficult for mortgage lenders to do. So mortgages were, you read all the articles, mortgages were being taken off the market because they were finding it hard to price and to offer a price for a period of time. That's the point. I mean, when you offer somebody a mortgage, you give them it for a period of time. And of course, the price was going up. We are now seeing, again, both of those elements settle down. There are more mortgage offers coming onto the market, and we're beginning to see now the price come down, because one of the points we make is that although we increased obviously our rate by 75 basis points, that was fully priced into the market in the curve. What we are seeing now, as we were talking about with this risk premium coming out, is that the new fixed mortgage rates are beginning to come down, which is what I would have expected to happen.
Thank you. Anybody else know that? Okay. Lenders were quick to increase mortgage rates following the mini-budget on the 23rd of September, but have been slower to reduce them in lines with falls in swap rates. Do you have messages for lenders about their approach?
Well, I have given the message once or twice, is that this is what I expect. I would expect to see happen, and quite when it happens, I think that is a decision for lenders, because they've got their own pricing arrangements. But I would have been surprised and frankly disappointed if we hadn't seen this happen, and we are now seeing this happen. So that's what I would say in terms of fixed rate loans.
How damaging was the mini-budget for first-time buyers in both the short and medium term? Because we had the major lenders in a few weeks ago, and while they completely agree with you that more products are coming back onto the market, they told us the ones that are missing or not as coming back as quickly are the high loan-to-value ones that specifically you would anticipate the first-time buyers would be looking at.
Yes, and that's important, because the lenders will be more cautious about those mortgages because they're higher loan-to-value. Therefore, they've got a smaller slice of, if you like, sort of equity in them. So that's not unusual to see that delay. I would hope and expect that we will see that. That come away too. But obviously, to your point, if you were trying to get a mortgage during that period, first-time buyer or second-time buyer, you were going to find it much more difficult. It was a very difficult period, and we saw this obviously in a lot of press coverage of it, obviously quite rightly.
Do you think lenders acted fairly in the way they withdrew loads of those products and offers? I have a particular constituency example which I've mentioned several times, of a young woman who was hoping to buy on a shared ownership basis, only to have the offer withdrawn just after the mini budget, and then several days later to come back with an interest rate about 2% higher.
Well, I don't want to. I can't. Obviously, I hope you'll understand. I can't comment on any individual cases. That's not possible. What I would say is that it was very difficult for the lenders to price mortgages when the curve was so unstable. That's the problem.
And that instability was directly as a result of the mini budget.
We were in a very, very unstable period. Yeah.
Thank you. Many market commentators are predicting falls in house prices over the coming year. I think the gentleman from the Nationwide was looking at kind of between 8 and 15%, but out on his extreme end, he did consider 30. I appreciate that's kind of a very large number, but what does the Monetary Policy Committee expect to happen to house prices over the next year?
Well, we don't directly forecast house prices. However, two things I would add, and colleagues will come on, is first of all, some of the sort of the parts of the story that we've talked about quite a lot already this afternoon. So obviously the real income shock, the prospect of recession, the fact that we've got wages that are obviously in real terms not increasing, all of those things will have an impact. The second thing I would say is that if we look at quite a lot of housing market indicators, I think they are all now showing a weakening, both the activity and the price numbers. I say weakening in particular on the price numbers more in terms of a weakening of the rate of growth. I mean, there was a series published this morning which was almost flat, had come off further, and I think that's the weakest for a year or more, actually. And also I'd say the volume numbers, so number of transactions have also weakened. So we are seeing that, certainly.
What impact would price falls have on consumption and inflation?
Well, I think that's quite hard to actually map through. It depends on the sort of the cause of them. And I say you also got this one to say it's not necessarily price falls. The other thing that you've got to look at is what I would say is sort of is loan to income ratios, for instance, and debt servicing ratios. So, obviously one of the consequences of us tightening monetary policy is that debt servicing ratios are going up. And it is also quite possible that even if in real terms house prices don't rise in nominal or real terms, you've then got to relate those to whatever happens to earnings. So I don't know if colleagues may want to come in on this, but on its own, I wouldn't look at house prices just on their own.
I mean, it's part of the, we don't, as Andrew said, have a separate forecast, but I would see it as part of the overall effect, for example, of tighter monetary policy, that has on consumption, rather than picking out the cause of house prices directly. The other thing I'd say is that as important in a typical cycle as those effects on consumption are what happens to housing investment, which is extremely volatile and extremely cyclical. So it is the case, and this is in the report, that we expect falls in alongside falls in housing transactions, we expect falls in housing investment. That's both spending on renovations and building of new houses.
It's also worth saying, and Catherine was discussing something, because coming from a US background, it's quite different. That the UK mortgage market is different. The housing contract is different in this country. You can't walk away from houses as you can in the US. So what we find, and this has fed a lot into the FPC's work on housing tools, is that consumers will prioritise mortgage servicing over other consumption. So it's often the weakness in other consumption that shows up.
So when you were asking the question about the implication for consumption, it's very important to distinguish between a borrower who has to refinance at a higher interest rate because their term of their mortgage has run off, and so they have to refinance. It's a higher interest rate. It means they have to pay more. That has an implication for consumption because they're going to prioritize paying the higher mortgage. That's different from a house price fall for somebody who doesn't have to refinance. They might look at, if we think of housing as a way of saving, if the price of it falls, it kind of looks like your savings isn't as big as you hoped it would be. And so you may consume less because you want to build up these different types of savings, the housing savings and the bank deposit saving. But you don't have to do that. Whereas the first one,
we can only hope that we could return to a time when we regard housing as somewhere to live. So, yeah. As you suggested earlier, you gave the proportions. Only around 30% of households have a mortgage. Of those, only a fifth are on floating rate, and only a quarter are on fixed rate that will expire by the end of 2023. How much of the burden of fighting inflation is being borne by the minority of households?
Well, I think obviously one of the impacts of introducing the growth in the fixed rate mortgage system is that it does have differential impacts, therefore, across households depending on when your mortgage resets, as Catherine was saying. Because unlike the US, obviously our fixed rate periods are short, not like the US, where they're there for the life. So obviously, I'm afraid there is a bit of sort of luck of the distribution and comes into that as to when your mortgage reprices versus the interest rate cycle.
The other thing to say is that monetary policy works through lots of channels. It's not just the the cash flow effect that Catherine was talking about is important, but there are lots of other ways in which monetary policy affects inflation. So I don't think we should imagine that it's only those people who have mortgages, or even amongst those, only those who have to reprice, who, as you say, bear the brunt of fighting inflation.
For example, the buy-to-let market is another channel through which, again, agreeing totally with Ben, there's many different channels for monetary policy, but just focusing on this one associated with housing. The buy-to-let market, the question is, for those owners, landlords, when they reprice, what happens? Do they pass on the higher cash flow obligations to their renters? And so that expands the pool of citizens and others who have to pay for a higher cost of housing.
Interestingly, we've seen rather more of a shrinkage of the buy-to-let market in the last year or so than certainly I'd sort of expected. I think that may be down to sort of some of the tax system has become more complicated, and so some of the people are saying, I just don't want to. I don't want to be bothered with this anymore, but it's quite interesting. It shrunk more than we expected.
Thank you, Chair. Thank you so much, Siobhan. And just on this important question of mortgages, because it matters so much to our constituents, how much, as of today, versus a year ago, you've moved the base rate from 0.1 to 3%. So inevitably, mortgage rates have increased. Yeah. How much of the increase that you see in the mortgage market today has come from that independent decision by the Bank of England to tighten monetary policy, and how much has been due to the disruption to the gilt market that we saw in September and early October?
I think the September-October thing was obviously a fairly short-lived thing.
That's gone now, has it?
Well, I think it's pretty much on the way to having gone. Yes. So I think that was a thing that sort of ran from sort of, I don't know, let's call it at the beginning of September through to sometime middle of October, and then obviously it didn't disappear immediately, although some of it came off quite quickly, so that's a much more short-lived.
We can send all our grumpy constituents about their increased mortgage rates in your direction.
To us, right? Yes.
Governor? Yeah.
Well, of course, I'd love you to send them somewhere else, but I'm afraid. But of course, ours is a deliberate thing in that sense. I'm afraid ours is the longer run effect, I think.
And of course, as Rishanara rightly says, except for the ones who had to fix during those few weeks.
Yes,
indeed.
And that's one of the problems, as I was saying, about this sort of luck of the timing thing. Of course, you can be very unlucky in that.
Seek compensation from the former Chancellor and Prime Minister.
Well, that's for you to pursue.
Alison, do you want to come in now?
Sure, happy to. Yep. I've just got some questions around the sort of around fiscal policy and the relationship that you've had with the Treasury and the government about the previous mini budget and the upcoming one. I'm not going to ask you to speculate on what we might see tomorrow, but Sir John
I don't know what's in tomorrow's statement.
Sir John Cunliffe, when he came to speak to us in October, it was quite clear that the bank had not really been told very much about the contents of the mini budget at all, and I just wanted to know how much you had heard about that before it happened, and what communications were like.
So John was right. Just put it in perspective, obviously we knew some of the statements that were made during the election campaign for the leadership of the party, but obviously they don't translate into anything sort of specific. Beyond that, I have to say, for two reasons, it was unusually sort of up in the air. The first one is that clearly, if I'm honest with you, I think this has been borne out by sort of statements made by the former Prime Minister and the former Chancellor. It was just not clear what was going to be in this package. And so we didn't have a clear steer on that. I should say, I think Treasury officials told us everything they knew, but this was a general thing, not specific to the bank. And the second point I made, which is a very important point, is that because the OBR were not involved in it, we put a lot of we get a lot from the OBR in terms of the process when they do a forecast, because they forecast out the sort of the spending and tax decisions, and we feed those OBR projections into our forecast as the means of taking fiscal policy into account. So even if we'd known what was going to be in it, in the absence, which we didn't, but in the absence of the OBR, we would have been, at a substantial disadvantage, because we'd have had to try and do it ourselves, which I say we don't normally do.
Okay. If you had known more details about it in advance, would you have warned the government about the path they were on?
Well, that's a bit of a hypothetical, actually. I mean, I'm sure there would have been I do talk to the Chancellor quite often, but that's a hypothetical.
Okay. The most recent Chancellor has written to us saying that the Treasury provides the MPC with all relevant information so that you can execute your role effectively.
Yes.
Would you agree that that's
absolutely. I mean, it's a very strong relationship, or I think has been throughout the life of the MPC, and it's very well sort of set out and developed. So there's no problem with the relationship with the Treasury.
Okay. The energy price guarantee will be a major determinant of the MPC's next forecast and interest decision. Did the uncertainty over the scheme's replacement from next April affect your November decision? And you mentioned about energy prices being a kind of quite an important impact on where you're going with this.
I can describe, when colleagues want to come in, I'll describe how we went about that, because it was a rather different situation in that case. So, as you say, clearly we knew the picture from now till April, so we were able to put that in. Now, just to say, the approach we take is that we condition our forecast on what I call, quotes, announced fiscal policy. So we had to think hard about what the word announced means in this context. But what the Chancellor, of course, the current Chancellor had said was that he wasn't going to announce what he was going to do after April, but there would, I think I'm right in using these words, be a more targeted policy. What that meant is that I think, if I can describe the two bookends to this, one bookend would be that he was going to continue with the previous Chancellor's policy, and the second bookend would be nothing. And I think both of those were explicitly ruled out by what he said. So we couldn't default to either of those. So we took what we called we made a stylized assumption of interpreting what he'd said, and that was basically to take the futures curve for gas, to take gas as the easiest one, and then essentially map that into what we thought would be an off-gem cap, and take basically halfway between, sort of the full level of the full policy as announced from now to April, and what that would buy. So I think in April, I think I'm right, so colleagues will correct me if I'm wrong, that one end of it would have been £4,500 as an average annual subsidy. The other would be about £2,500, and I think our number's about 3,400. I think that's the midway through. And we then projected that forward for the remaining life. That's how we did it. That is based on no inside knowledge of what the Chancellor's planning to do. It's what I call a stylized assumption.
Yeah, no, that makes sense. You've got to go on the basis of what information that you have. Cornwall Insight put the estimated cap at £3,702, which is slightly higher than where you are forecasting that.
Oh, for their halfway house?
Yeah, for their kind of estimation of where the cap will end up.
Well, yeah, I'd have to look at that, because, I mean, I was going to say there's a futures market price in there, so you could get different numbers at different points in time quite easily. We will quite easily. That curve moves quite a lot.
Okay. What the Chancellor told me yesterday was the energy price support we give to families will not end next April, which doesn't seem particularly wide. I was just going to try and ask what impact it would have on your decision making if the support was quite narrowly targeted, but so therefore other households would be paying significantly more. What impact that would have on your decisions?
I mean, there's more than one part to this. I mean, there is what I call the inflation part to it. In other words, what does it do for the path of inflation? But then there's also the demand side, because relative to the counterfactual, so relative to, say, the August MPR when there was nothing in there, of course, these sorts of fiscal measures do inject demand into the economy relative to that. So we have to factor both in, but colleagues may want to...
The way I like to think about this is that the cap, there is mechanical effects of the cap on the CPI.
Yeah.
Okay, and we can look at that and we can change it. But what's more important is that what the cap does is it provides a strategy whereby instead of paying a lot for energy or for gas, people will pay less than what the futures curve would suggest. They then rotate that extra purchasing power towards other goods and services. And how much rotation there is depends on how big the what the program looks like. It also depends on what the deciles of income are, how targeted it is. If it's not targeted at all and everybody gets it, then you get one impact. If it's very targeted towards the end, you get a different impact. So it's this rotation towards spending on other goods and services that is the really important behavioral response, and that is something that's more difficult to calculate. Yes. But we know it's there, and so we do incorporate that qualitatively into our assessment of inflation.
Okay, that makes sense. And is there a different impact on inflation because there is no cap on businesses?
And to say there is a different impact on inflation, probably. The ONS are the arbiters of this, if it's targeted. Possibly. So a lot of these two effects that Andrew and Catherine have been talking about, one directly on CPI inflation and the other on demand. The demand effect is predominantly in what's the size of the package compared with what otherwise would have happened. And that has some positive effect on demand and future inflation, all else equal. The direct effect on the CPI depends on how the ONS interprets such support. So there was some support before August, targeted. That did not affect consumer price inflation. It didn't help reduce it. What came in August did, which is why alarmingly high though it is, the figure of inflation today would have been higher in the absence of that. A more targeted scheme, the ONS may not count as affecting prices. So it will have some bearing, it could have some bearing on that targeting on any direct effects on inflation. And businesses, I think we would treat, as in the way we normally treat fiscal transfers of that sort.
Okay. Some of the businesses that I've heard from are having to buy into eye-wateringly, impossibly expensive contracts, which they're shielded from just now, but they won't be shielded from later on. And I just wondered what impact that would then have on the decisions that you have to make.
Businesses. I think it'll go into the forecast for demand. I mean, this is a macroeconomic forecast, so we don't, except in some areas, go much below the surface and say, I think it would be treated as an ongoing effect of higher energy prices on real demand in the economy. I mean, it's a bit like, you're absolutely right, though, that there are, some of these are quite long-term contracts. And just as we were talking about earlier with the mortgages, some people rolling off, there are companies that are rolling off what, compared with the spot price today, have been relatively low cost.
We asked, our decision maker panel asks firms how they react to different costs. And energy costs are one of the things that they believe that they can pass through, unlike some other costs where they feel that it's more difficult to pass through those costs into prices. And so to the extent that there is no, that the cost structure of energy continues to be upward sloping, well, then that puts additional pressure on firms to either raise their prices or reduce their margins. But as one of the observations that we have right now is, in fact, the futures price is quite downward sloping. And so going back to what Ben said, if you could kind of wait and not sign a contract today.
Yeah, most people are not lucky enough to be in that position.
That's a strategic decision, and for an individual firm to make. Small firms can sometimes band together and work with a contract through that channel, but
okay, that's fine. And just to go back, I suppose, to some of the kind of process stuff around tomorrow. Originally, tomorrow's a fiscal event was going to be prior to your meeting, your decision. Did the moving of that date have any kind of problematic effect for the decisions you were taking?
Not really, no. I mean, I've described how we dealt with the energy price side of it. Everything that's going to come tomorrow is not in our in the MPR because, say, we conditioned on announced fiscal policy. Nothing was announced, so we'll take that on board. First of all, at our meeting in December, and then in our next forecast for the February report.
The mini budget was kind of briefed by the government as not being a major fiscal event. do you regard tomorrow as being a major fiscal event?
Well, first of all, of course, the big difference is the OBR are involved. I mean, I'm not an expert in this field particularly, but I gather the term fiscal event is a bit of a term of art.
I mean, the mini budget did turn out to be quite an event. So.
Yes.
Yeah.
It wasn't briefed as such, though.
I'm led to believe that when it's a budget, the OBR have to be involved according to the legislation. Fiscal event is this term of art that is that doesn't that skirts around the legislation. If I can go that far in my comment.
Okay, and I suppose sort of finally, would you expect to have had any? Have you had terribly much briefing on this one, and would you expect to have had? Given the previous turbulence.
First of all, I mean, we're not, of course, in a MPR, in a monetary policy round at the moment, so we don't have any need to have briefing on a particular day of the week because we're not meeting at the moment. And you know, I saw the Chancellor last Friday, but we didn't discuss what was going to be in the package. I think he was still working very hard on it, so I shall wait to see. So I don't know what's going to be in it, but that's fine. It's not a problem.
Thank you, Chair.
Thanks. Can I just pick up on a couple of points that came up there? With Ben Broadbent, the difference between stopping energy prices affecting the overall CPI and then helping households by paying direct into their bank accounts could have an impact on monetary policy through lowering wage demands in this wage round, couldn't it? Do you see a difference in terms of those two approaches?
If we take the earlier which, as I say, had both these effects. The direct effects of lowering the CPI for a while, and as I said, the peak in inflation, level of inflation now, should we say, whether it turns out to peak or not, would clearly have been higher without the schemes. At the same time, it supports demand, as Andrew and Catherine were describing earlier. Actually, in the forecast we've had and the assessment of the committee, that second effect is bigger than the first, as far as medium-term inflation is concerned. So you're right that one of the effects may be to temper the pass-through from prices to wages and so forth. In our judgment, the larger effect was on demand, and therefore the net effect on inflation forecast in the medium term was positive, and that was one of the reasons one of the things that many committee members cited in decisions to raise interest rates.
Thank you. And Governor, you mentioned a couple of times just now that you're meeting with the current Chancellor on a regular basis. Would you say the frequency is different from with previous Chancellors, and how often should a Governor meet with a Chancellor to remain independent Governor?
Well, I think, look, first of all, I don't think independence is the point. I mean, we have many things that, obviously across the whole sort of scope of our activities that we talk about. So, current Chancellor and I probably, we talk once a week or so. I think that's fine. It was. How
does that compare from when the Prime Minister was Chancellor?
Oh, when the Prime Minister was Chancellor. Well, I mean, to be honest, it's also a bit sort of dependent on the sort of what's going on in the state of the world. So the Prime Minister...
Frequently then.
Sorry?
Frequently then.
Well, hang on a minute. So
the current Chancellor frequently.
When both of us were very new in our roles and COVID broke, we were talking daily. Because we were sort of, frankly, it was a crisis, clearly, and we were talking daily. But in the normal sort of sequence, I think it's somewhat less frequent than that.
We're not really used to normal just recently.
Well, there are degrees of normality, okay, or degrees of crisis.
Should our constituents want this to be happening less frequently, I guess?
No, I think, really, let's be clear, I don't think independence depends on how often the Governor and the Chancellor talk to one another. I mean, it's a careful balance. Of course, independence is, depends upon well-established institutional settings. But I do think your constituents also ought to expect the two of us to, to make sure that we are appropriately in touch with each other. Because there are many things. We have to talk about regulation, for instance, and we have to talk about international issues because we go to the same meetings.
Right into Ruchanara's next set of questions, Yeah,
thank you. Thank you very much. Yes, back to regulation and the Financial Services and Markets Bill. Given the decision by the government that it will be able to directly regulate to make, amend or revoke rules where there are matters of significant public interest, and given that so far the government hasn't defined what public interest is in their eyes, notably the minister when he was here, are you concerned that this is a threat to the independence of regulators?
I am concerned about it. I think we have had this discussion once before, but I'm happy to develop the thought. Yes, I am. I think. Let me start by saying I think there's a sort of well-established sort of division of responsibilities. I think don't mind me treading on your toes for a moment. Parliament legislates. The government, or the form of the Chancellor, sends me remit letters every year describing how they interpret the remit, particularly in the light of their other policies. I think that works well. We as regulators operate the regime. You hold us to account, and all of these parts are important. And what I'm concerned about is that I think this power muddies that division of responsibility, and so I'm not a supporter of it in that sense. I'll also...
Sorry.
Well, no, I'm going to come back to the point you made at the start, which is an important one. I also have to tell you, let me say two things about sort of the international situation. First of all, I think there's a lot of talk about competitiveness. I think it's important to bear in mind that in an international financial centre, which is what we are, we're the world's leading international financial centre in many ways, part of competitiveness is having an effective legal system, and part of it is having an effective regulatory system. And it's not, I'm not just saying this because I wouldn't I? Firms will say this to you. It's not just me who says it. And we must not threaten that.
We have, our government has, by breaching international law on other things.
Well, I'm talking about the legal system here.
Sure.
The English common law system. Because it's interesting that wholesale financial activity generally takes place in common law systems. Not so English ones, but common law systems. The other point I'm making, I have to go back to the last couple of months. We have damaged our reputation internationally.
Because of the domestic
Because of what happened.
issues
I was
September.
in Washington, as is well known, because I was somewhat in the news, at the IMF annual meetings, which is the biggest events of the year internationally. I was at the G7, the G20, and so on. And we have damaged that. People saying, we didn't think the UK would do this.
You're talking about the mini budget.
Yes,
and the trust
and it will
quartile.
take longer to rebuild that reputation than it will be to correct the gilt curve.
And that damaged financial stability. So I want to ask you the question:
tread carefully.
Does this risk posing a risk to financial stability if it is interpreted
I think
in the way that was?
If it's a power that is interpreted as going into our remit, it muddies the waters. Now, here's the point, because you made an interesting point at the beginning, I wanted to pick up on it. Going back to 4 chancellors ago, when the Prime Minister was Chancellor and the now Chief Secretary was Economic Secretary, when this discussion started, there was a discussion, to your point, about the public interest.
Yeah.
And I can see, because I had some experiences more when I was at the FCA than the Bank of England, that there are issues that come up which are outside the remit of the regulator, which can be difficult to handle. National security is the best example. I'm probably slightly treading on the toes of my former organisation here. We had a case, I think it might come up at this committee, did it one committee, of a Russian listing. And people said, well, why haven't you stepped in and stopped this? And I had to say, look, it's a national security matter. Actually, we don't have a power, and we shouldn't have it. The FCA or the Bank of England can't exercise national security. So there is an issue there, but that is explicitly outside the statutory remit of the regulator. That's saying, what if there's to your words, what if there's a public interest issue that isn't in your remit but is relevant?
It would be
we
helpful.
could discuss that.
Sure, it would be helpful if the government set out, laid out what they mean by public interest.
Well, I haven't seen it.
We haven't either.
No,
So you haven't seen the draft. You haven't been. You haven't seen the draft amendment.
No, I saw
despite the fact that the
to be honest with you, I saw
regularly.
a skeleton of something 4 chancellors ago, but I know that's not.
4 chancellors ago. That's a very long time ago.
That's not long, I know, but no, it was when the Prime Minister was Chancellor.
Is it right that the current chancellor who's speaking to you weekly isn't addressing the very issue that could compromise your independence, your institution's independence,
Well,
as well as others.
we will be discussing it. I mean, obviously,
Well,
he's been quite focused on fiscal policy, I think, and that's important.
But this is important for the
It
reasons
is.
you've
No,
said.
it is, and we will discuss
and
it.
just to, the reason why I think it's so important, and I hope you would agree,
I do.
that we need to understand what public interest is, because of course the government can argue quite correctly that it has a democratic mandate, but there are specific arrangements for regulators correctly for the reasons you've said. What we know is that financial businesses, for instance, or their lobbyists met Treasury ministers nearly 200 times last year alone. In the same period, Treasury ministers met consumer organisations fewer than a dozen times. So there is a clear imbalance between the consumer interests and financial services and their interests and their ability to lobby government ministers. And my concern is that actually there's a real risk that ministers will come under pressure, and political pressure and pressure from powerful lobby interests. And that could skew what public interest actually means and damage independence.
Well, that's why I think...
And we saw that example of, the former chancellors.
Which one?
I think the last one. The chancellor, the mini-budget chancellor, Kwasi Kwarteng. I wasn't sure if I should refer to him by name or his constituency, but as I'm not in the chamber, that he was, there were reports about him being him having meetings after the budget with his former employers and so on. So there are issues around the nature of the relationship between politicians, ministers, and other institutions.
Well, that's why that's a really good point. I mean, that's why I set out at the beginning very deliberately the sort of this, what I think is quite carefully constructed division of responsibilities: what you do, what we do, what ministers do. Yeah. Because I think it's it's a balance that seems to me to work effectively. And I would say this: of course, we're not democratically elected, and we have to be very conscious of this. But the whole system is a democracy. It's not one bit of it's a democracy. Yep. And our legitimacy. The reason our accountability to you is so important is because it's actually part of our legitimacy as part of a democratic system.
If you were discussing the changes, what I'm hearing is that if there may be a necessity, but it needs to be very, very carefully defined around the points you made around national security or things that go outside the scope. It needs to be very, very clear. And at the moment, it's not.
Well, I think two things. I think yes to that point. I'd also add that I think, and again, it's not for me to say how this should be done, but I think Parliament, I would hope when it debates that, would consider what role as an institution Parliament plays in the whole sort of legitimacy and accountability of that system, for the reason that you gave a few minutes ago, which I think is important, if that's the road we go down. I don't think I have to say, because of the remit letter system, I don't actually think this is a necessary power.
Do you think there is a
within our remit?
Sure. Okay, so do you think there is a general trend now? We heard some of it during the leadership campaign, Conservative leaders' leadership campaign, and we've heard it among some parliamentarians, a sort of assault, maybe that's too hard a word, on the independence of the bank. And given the rates are going up and the things that you've had to do necessarily, some would argue, and in some cases your responses had to be in the relation to the mini budget, that actually the bank can find itself being the fall guy, and because it's convenient for some people politically to do that. And of course, as we know, we've had exchanges where I've been critical at times of decisions that the FCA made under your rule, and that's our prerogative to do so. But is there a risk that the bank's independence is going to be under further attack and assault because of the kind of pressures, if you like, and the things you're having to do? In the case of September, you had to respond necessarily, but now because of the wider issues we've discussed earlier on, international dimensions as well as domestic dimensions.
I would say, obviously, our independence, is absolutely paramount in my, thinking and all the way I go about doing my role. I also am very clear, and I hope you don't mind me saying this, that if there was any threat to our independence, I would expect to tell this committee, that was, in my view, the case, because you're a very important part of this.
Well, I would put it to you that this so-called public interest amendment, if it's not carefully defined, and the FCA, your former institution that you ran, and the chairman made it very clear that, like you have internationally, there's a real risk to anything that could undermine the independence of these institutions to our economic stability, our financial stability. I would put it to you that, given that the Chancellor meets you on a weekly basis, this should be, perhaps not this week.
Well, I can't speak for the Chancellor, but
this should be central.
I think it's well known by ministers what I think on this issue.
They don't seem to, despite that, they don't seem to be making much progress on addressing these points. And you discussed the draft amendment 4 chancellors ago. Now, even before the mini budget chaos, shouldn't this be a priority for the ministers to discuss this provision with you and other regulators?
Well, I mean, I think
given regulators are you and your previous organisation, the heads of those institutions, Nicola Rathi and the chairman, Richard Lloyd, when he gave evidence, have made it very explicitly clear their concern about
Richard's
it.
a very serious, he's very serious. I mean, I respect what he said, and I thought it was well put. What I would say is this. I mean, I mean, this amendment has been promised to be introduced into Parliament for some time, and it hasn't appeared yet. I haven't seen it. So, yes, of course I want to discuss it, but, I haven't seen it, frankly, and I don't know precisely why it hasn't been introduced into Parliament when it has. I think that's a question you have to ask ministers.
Yeah, and we have, and the minister couldn't even define public interest. And the issue here is that actually we're being asked, Parliament is being asked to allow ministers to make those decisions around what public interest is. So Parliament is being taken out of the equation as well, which is of real concern, because you rely on Parliament to be able to stand up for, and this committee in particular, to highlight the importance of independence.
Yeah, and I rely on you to ask me what's going on, and thereby we get the accountability.
Yep. Well, that is part of the problem here. Okay, I will stop here, but I very much hope that the Chancellor, and we will raise it with the Chancellor when he's here next week.
We certainly will.
Thank you.
We certainly will. Thank you very much, Rushanara. And have you got your brush back, Emma? Emma has been asking a point of order in the main chamber. Have you got your brush back?
Yes.
Yes. Okay.
Thank you,
Emma.
Chair. Apologies for my my absence for a while. Governor, just we could start with an interview you gave with Sky on the 3rd of November. When you were asked about the impacts of the mini budget, you had said that will have some lasting effect, and we will frankly have to work hard to put that in the past. I wonder if you could elaborate on the lasting effects that it's having, and what the extra pain is that the UK is
facing. Yes, it's slightly, sorry, it's slightly picked, but I didn't really answer that point. I started when you were out of the room, but I didn't really develop the point. Because I said, we talked earlier and with colleagues about the effect on the gilt curve and how that was sort of coming out, but I then went on to talk about what I call the more lasting effects, which we have to work hard on. And I made the point that, as is well known, because I sort of popped up occasionally. I was in Washington at the IMF annual meetings when a lot of the sort of this thing came to a climax. And I have to tell you that, and I don't think this should come as a surprise, that the UK's reputation internationally has been affected by this. I mean, people have said to me, I didn't really expect this to happen in the UK. And I think we do have to work hard to rebuild the UK's reputation in this respect, because it has taken I'm afraid it has taken a knock in that sense. Yeah. And that's the lasting point. And obviously we've all got a part to play in this, and we will do it.
So, other than the reputational lasting effect, is there any other? I know Kevin, your colleague, mentioned about because of just before I left. Because obviously the pound fell, and therefore we're paying more for food because we're importing food, and that's having an impact on inflation. So are there other lasting effects other than potential impact on inflation from when the pound dropped?
I don't know, what colleagues. Yeah.
Please.
Well, I think you heard earlier that most of the very dramatic effects on forward interest rates on the exchange rate around the time of the mini budget do seem to have dissipated. Now, whether that means the risks have gone entirely, it's hard to say, but certainly the measures we have of that, and as Andrew said, the spread between our interest rates and those in continental Europe and the US, or as I said, the currency, most of that has, for the time being at least, gone. And there will be expectations in financial markets of tomorrow. I don't know what those are, but I imagine that there's some expectation to do with fiscal sustainability. So markets will always pay attention to policymakers. I mean, the events at the end of September are a pretty stark illustration of that. But as far as we can tell, as things stand, most of it's gone, I think.
Okay. And Governor, do you think the UK experienced higher borrowing costs because of the, I'm using your phrase, the UK specific factors, and to what extent are they persisting in terms of impact?
Well, I think it sort of comes back to what Ben was saying. I'm sorry, we may have sort of said one or two things on this when you were out of the room, but I think, I mean, yes, during that period there was a UK risk premium, and you can see that if you look at if you sort of baseline UK euro area and US interest rate curves at the beginning of August, and then sort of show the sort of the change in those curves. You can see it. It's very easy to see during this period from sort of roughly sort of middle of September through to the middle of October, and then it starts to come off after that. So yeah, you can see it.
Yeah, I'm just wondering, thinking of other UK-specific factors, we had some really powerful evidence from Sanjay Raja, the chief UK economist, in terms of our trade deficit, the UK's trade deficit, and to what extent that our trade deficit is having an impact. And he said, if you look across developed markets and emerging market economies, the narrow basic balance the UK has is extraordinary. It is one of the worst among developed and emerging market economies. So to what extent is our trade deficit?
Well, a trade economist, isn't it?
Lovely, lovely. Our trade deficit.
I'm a real expert here.
Yeah.
So apologies if I've said something before in case I overlap. But broadly speaking, we're underperforming in terms of our exports, and of course that's going to show up in the current account deficit. We also know that with the currency depreciating, and I'm talking about sort of a longer run horizon, how much it's depreciated, that's also had a really significant impact, which is to say that everything we buy is becoming more expensive, and those things have a contractionary effect, not an expansionary effect. They're not increasing our exports. So in that sense, that's a factor, but from a monetary policy point of view, I can say that we're not exchange rate targeters or current account deficit targeters. So in that sense, it can only be a consideration in terms of how it impacts economic activity and inflation, but not directly.
Yeah, and why are we underperforming in our exports?
Largely, partly it is to do with the types of sectors we operate in, which did take a hit more than most in terms of the pandemic. But more importantly, with Brexit happening, there will be some level of impact, which is coming through supply chains and whether you want to continue to locate in the UK or not. In terms of sort of where you can see sort of evidence of that is that we are much behind. Even sort of the best example I can give you is Canada did really badly because of during the 2019 to 2021 period in terms of its openness, which was about 4% drop in trade by GDP ratios. In the UK, it's 8%. And Canada is pretty much the worst out of that lot of countries. So in that sense, we're really underperforming compared to our peers. And that's the sense in which, of course, trade agreements matter. That's showing up. The kinds of sectors we operate in, that matters. The rotation towards goods versus services, particularly problematic for the UK because we're so reliant on services compared to other countries.
And just to sort of, how has the fall in the value of the pound impacted inflation? Just to pick up on a point you made before, Catherine.
So if with a 20% depreciation of sterling, that's the longer term. It's not the sort of September event. Then you get about another 10 point on inflation. So you do have a pass through.
And 10 points as in 10%? Sorry, 0.1%.
0.1, if I'm correct on that. there's a
Yeah, I mean, we
Want to
relationship.
clarify
Yeah.
for the public watching, yeah.
Right.
but the exact number, it's not 10%, no, it's
No, no.
0.1. But I mean, it's a, you know,
0.1.
I think so. I can't remember what shock you started with, Catherine.
The 20% depreciation.
I normally think of 10 going into
So
my
I think it's
memory as
1 to
well.
10 to 1.
The pound is up
It's-
about 20% from the low, isn't it, today? So
No, we're talking about say,
yes,
from
but
January.
Yes,
So-
since the since
So
the beginning
about
of the
20%
it's
depreciation.
fallen 20. How much is that worth in terms of the inflation rate?
Maybe about 0.2. So
0.2%.
I'm not sure it's 20% down trade weighted. I think it's less than that trade
I
weighted.
do expect you guys to know this
Yeah,
statistic.
no, it's not trade weighted. But I think Catherine's right that it's 10% does 0.1, 10% on the trade weighted exchange rate.
If it's 20%, then we're looking at 0.2.
So it's not a huge, and that'll extend further for a second year. And I mean, it does make a difference. It makes a much bigger difference in some areas than others. More tradable things, goods, generally, food and so forth. But let's be clear that the big effects on import prices, on our real incomes, are not to do with that. They are to do with the pandemic and in particular the war. I mean, by orders of magnitude. So, look at the food price numbers this morning. I think they're up 14, is my memory, in the year to October. In the euro area, they're up 13.1 or 2. So they're very similar. This is not, that 14 is not because of the currency, it's because
what I'm
of the
keen
war.
to sort of, I suppose, understand is to what extent the depreciation in the value of the pound is impacting the prices and the inflation that people are facing. And I think, as the governor said earlier on, he was talking, and I thought it was a really good point about the different percentiles feel in terms of inflation. And I think we all recognise that the people on lower incomes feel inflation at a higher rate than those on higher incomes. So I suppose what I'd be keen to know, and do right if you don't have the figures now, is how has the depreciation in the pound impacted the inflation that's felt by some of the poorer people in our society, particularly when it comes to the price of food, is what I'd quite like to know.
Why don't we, it's an interesting point, given the sort of the impact on different sort of income deciles, so we could write to you on that.
Yeah. I think we should. I mean, as I say, I think unfortunately,
Because 0.2 sounds nothing to people
Well, we
on
do
higher
share
incomes, but what does that mean in terms of a basket of goods to someone on low income?
we share a lot of this inflation because of where it's come from. Very similar rates in continental Europe, which kind of tells you that the currency is not really the big story here, unfortunately.
And other than you've mentioned, obviously, the war in Ukraine and the pandemic, what are the other main global factors impacting inflation at the moment?
Well, with the pandemic, it's really the supply chain consequence, which arose really for a couple of reasons, which are related obviously closely. One was the shift of demand from services to goods, which, by the way, is pretty much corrected. It's gone back in this country. Hasn't so much in the US, though, actually, interestingly. And then the second one was the supply chains themselves, which obviously, China being an issue there, particularly in terms of the impact of the zero COVID policy in China. Now, certainly, and again, we saw that this morning, inflation number, the core goods numbers do seem to be now begin to come off, and you see that in the US as well. In the US inflation number earlier this week, you see that as well. So that shock is beginning to wear off. Although I should say, I mean, I was at a large production plant in Northeast last week, which is a big user of microchips, and they said it's still unreliable. So they were at a point where they'd had a good supply, and now they were having to scale back production because they hadn't got the chip supply coming through. So it is still unreliable in that sense.
So other than with Ukraine and the pandemic, are there any other global factors impacting inflation?
Well, I mean, there's obviously quite a different pattern. Sorry, you also have the room, I think. As Ben and others were saying, when you compare the US to Europe, you do see a different pattern going on. And, the monetary policy challenge is therefore different. The US has got a bigger demand shock element there. I was saying earlier, the level of growth over the period since the beginning of COVID is larger in the US. Fiscal policy support was much larger. Both the Trump and the Biden administrations provided substantial fiscal policy support. And so the Fed is much more in the position of having to sort of do the more sort of established traditional thing in monetary policy of having to push demand down and inflation down, whereas in Europe, and I use Europe geographically because we and the ECB have got similar situations, we've got this sort of trade-off situation where activity is weakening but inflation is strong. So we have got different, across the world there are different situations. Now China is another part of the story. I mean, China's economy has weakened over the course of the last, certainly this year, probably more than that. Maybe several reasons for that. One is the COVID issue. Second one is there's some well-known sort of financial stability weaknesses in the property sector. So China has been weaker in that sense. Mm. So there's a lot going on in the world economy. That's the big message here, that far more of the shocks that we're dealing with are global.
Okay, and my final question, Chair. In what circumstances would you as a central bank intervene to prop up the pound?
That has not been on our menu coincidentally, since 1992. I think we had the 30th anniversary of it a few weeks ago, actually. I do remember it, actually, sadly. That is not a policy tool that we entertain.
You wouldn't intervene? I
would not intervene in exchange markets, no. It is, I'm afraid, not got a happy record in that sense. And perhaps I could draw the distinction. I mean, it is a vastly different thing for a central bank to intervene in its own markets, where we are the supplier of money. So if you think about the gilt market intervention we did, it's very different from intervening in foreign exchange markets, where obviously our firepower is limited. So, no, it has not got a good history.
Okay. Thank you.
Thank you very much, Emma. And what I heard you say, Governor, is that we have a free-floating currency, and the Bank of England is not going to...
As Catherine was saying, we take into account the impact of that.
Intervene on that.
Yeah.
However, as you just alluded to, you did intervene with the quantitative tightening that you announced at the Monetary Policy Committee in September, and then, of course, you had to do the emergency intervention in the gilt market at the end of September. And I just want to ask very briefly about the Monetary Policy Committee angle, because we've heard evidence in the past that you're not sure how much quantitative tightening tightens monetary policy. Is that still the case, or have you done some work on that and you now have an assessment, a rule of thumb for us?
I'd say two things on that, and I'm sure colleagues want to come in. First of all, we always took the view that, and we've done a lot of work on this, as have other central banks, we've done a particularly large amount of work on it, that quantitative easing is state contingent in terms of its impact. It has more impact in periods where the markets are, the environment is destabilised than it does in more normal environments. And I would say, I don't see a reason not to think it's symmetrical. Now, I say that because we obviously have a choice when we do quantitative tightening, but we've said that we will not be selling gilts into disorderly markets, and that's why, by the way, why we delayed the start of it. So the point being there is we want to do this in an environment where it has the least impact, because it's not our tool of monetary policy. I mean, the bank rate is the tool we're using.
Is it possible, though, that the amount of quantitative tightening that you've announced means that you will have to raise the base rate by less? Is it possible that is
the way I would look at that is that the impact of the announcement and indeed the execution of the quantitative tightening will be reflected through into market rates, and we will take those into, obviously we always take those into account, so it will come through that way.
Thank you. And Ben, I know you want to come in, and just if you could explain how the Monetary Policy Committee was involved in the intervention at the end of September, to what extent you were directly involved, and the external members as well.
I'll take that first. Well, I was involved as a governor in those decisions. As the MPC was informed, I think there are some very clear distinctions between this.
You didn't approve it, but you were informed of it. Yeah.
There are some very clear distinctions between this and monetary policy. Let me actually come back to those in a moment. I just want to deal first with the QE/QT point, the monetary side of the use of the balance sheet. It's not that, our estimates of what any policy lever does are always imprecise. But I think the particular point with QE was not that we were very uncertain, so much as the point that Andrew made, that we thought the effects differed according to circumstance. And when markets are very strained, a given amount of purchases will do a lot to bond yields and to interest rates. And it is via its effects on prices of financial assets that this balance sheet policy works. So there is no fixed multiplier, and it would be misleading to provide one for that reason. It is not the case that, you know, a given number of pounds of purchases or sales of gilts from the APF does X to growth or inflation. And as Andrew said, our approach now is it's in the forecast via the yield curves and prices of other financial assets on which we condition the forecast. That's the way we tend to see it. At a very high level, let me now discuss the distinctions between the intervention in September and monetary policy. That is that this effect on prices of financial assets is one way of seeing the difference. So monetary policy says, well, here's what's going on in the economy. And in order to meet the inflation objective, given the forecasts, and as we discussed earlier, those forecasts can turn out to be wrong, this is what we would like, you know, interest rates to be, bank rate, and in the case of QE, yields further out. And then occasionally there are some financial disturbances. The dash for cash, for example, was one at the beginning of the pandemic, and very clearly what happened in late September was another. And a financial intervention, and this is something that central banks have always done through history, and it hasn't been seen as monetary policy, sort of prevents yields from moving away from that preferred path. And that's how I see the intervention in late September. Now, as it happens, it was very much located in the long part of the gilts curve because that's where the LDIs hold gilts and pension funds. So the task was to prevent that from moving in such a way that would have, you know, serious destabilizing and broad effects on the financial system and possibly ultimately on the economy. But it was a very different kind of intervention from QE into QT. It wasn't designed actively to move yields to a different place. It was designed to prevent yields from being moved by some financial disturbance. And in that respect, there were also operational differences. It was very much targeted at that long end, whereas QE and QT decisions are across the gilt curve. As we've said, it's temporary, whereas QE decisions were in some sense indefinite. The MPC voted, here's the new stock, with no presumption as to what should happen to it, whereas this, we've said, would be temporary, and we recently announced how we intend to unwind the purchases made as part of that intervention. And so I think it has very, very different aspects. Whereas QE was done, QT, by contrast, we want to be extremely smooth and predictable. And the main instrument of monetary policy is now the bank rate. So I've gone on a bit, but
no, thank you, and that was very informative. And I think what I heard is that given it's so state dependent, it's very hard to make ex ante estimates of what quantitative tightening is doing in terms of monetary conditions.
Think, as I say, our view is that whatever it is doing, we can judge by means of, you know, is passing through forward interest rates. So let's suppose that our announcement of QT has had some effect. That effect will be transmitted via the yield curve, and we condition our forecasts on the yield curve. And therefore, to the extent that it's going to have a tightening effect on the economy and in time on inflation, that is taken into account in the forecast and therefore on the decision of bank rate as well.
Also, just what I wanted to ask was whether ex post you will also publish your analysis of what you think it did.
Well, we have continually tried to refine our understanding of what asset purchases do, and I've no doubt we will do the same with asset sales.
Brilliant, which segs very nicely into the final section, and then we'll let you go and have a cup of tea. So, Anthony.
Thank you. So my questions are actually on the bond market. Bill Clinton, when he was first elected, a lot of his campaign promises were undermined by the international bond market not financing a lot of his things. And James Carville, one of his advisors, famously said, "I want to be, if I'm reincarnated, I want to come back as a bond market. You can intimidate everyone." And certainly in this country, we've learned the power of bond markets. I was just wondering, were you surprised by the sharpness of the increase in gilt yields following the mini budget, or the scale of the reaction?
Well, I think John Cunliffe said this when he was here. I mean, obviously the movements were unprecedented, certainly in modern times anyway. I certainly can sort of visualise the last 25 years and you don't see anything like that. So in that, I mean, were we surprised? Well, yes, in the sense that, you know, when that sort of thing happens, you don't sit there and say, yeah, I thought that was going to happen. So, I mean, it was a very big move. Now, I mean, was it, you know, I'm sure historians and economists will come back and say, well, was it large relative to the sort of the scale of the news? And that's a judgment to be made. But obviously it was a very big event, and it was not, given the answer to the earlier question, and I think Alison Chilis asked, given what, you know, we didn't know a lot about what was going to be in the statement. In that sense, you know, was this whole package of events a surprise? Well, yes, is the answer to that.
During the pandemic and afterwards, there have been a lot of big announcements with fiscal consequences, if not a fiscal event. So we've had the energy price guarantee scheme, for example, or the announcement of furlough. I mean, that was many tens of billions of pounds, and the various schemes to support business all added up to 400 billion, but they weren't mostly accompanied by OBR reports or indeed bond market reactions in the same way. So I'm just wondering why, if you have any thoughts about why this particular mini budget created such a large reaction when all the previous fiscally significant announcements didn't have a market reaction the same way.
I've talked to quite a few people in the market about this question as to what was it that, you know, you learnt that particularly created, for the reason you give. And I think
important for future chancellors to know.
Well, and I think you've already. Two things I'll point to. One of which you've already referred to, and that's the OBR.
But not all fiscal announcements.
Because it's what I call it's the flying blind point. Yeah. And thinking that was that was okay to do. The second thing, interestingly, passed on to me, and this is an interesting one actually, which was the significance of the top rate of tax announcement. Now, I say it's interesting because economically speaking, that's not the biggest
insignificance. It's 2 billion or something.
And these are not people who have a high marginal propensity.
Politically important, but fiscally.
But I think it was. I think the way people in the market put it to me, it was a sort of, again, you know, is that the right thing to do in this situation?
I think that
what do you draw from that?
I mean, it's a very good question. More generally, if you look back over the hundreds of years, actually, for which we have data on bond yields and government debt and so forth, the correlation between those two is actually pretty low. And I think what matters a lot is the context. And Andrew mentioned this earlier, the trust in international market and our institutional arrangements. And there are various institutional things on which credibility of fiscal policy and monetary policy rest. And if you do two things together, if you do something to suggest that somehow that might threaten that credibility, and at the same time you seek to go out and borrow a lot of money from that same market, it's the combination of those two things. I mean, I say this partly with the benefit of hindsight. It's not as if I...
Yeah, I think the other thing I would add is that I think, you know, the sort of the camp of believers in what I call sort of trickle-down economics of the sort of early 80s is not a very large camp these days.
The last point that I would add is, in comparison to the periods of time running up through COVID, is many different fiscal authorities were exploring strategies to cushion the blow, using many different strategies. And so what was different about September was basically being out there by yourself, whereas in the other cases, you had a lot of fiscal authorities were, as I say, doing many different things.
Can I add one point to that?
Yes,
which is that if you look at just the minute-by-minute data on either the exchange rate or the yields, there isn't something you can really pinpoint and draw out that this was the one point where things dipped, which quite often in many other events you can.
Yeah. Can I just unpack the point that Ben made? I think slightly diplomatically, but when you talk about trust in the institutions, you really talk about presumably the attacks on the Bank of England that happened in the preceding sort of months during the leadership campaign, and the dismissal of the permanent secretary of the Treasury and so on. The whole institutional structure seemed to come into play in a way that it hadn't been before.
I don't know, and that may have. I'm just saying that's
possible.
It's possible that it was the combination of those two things. I mean, as Swati said, to pin down minute by minute is difficult, not least because then some of the dynamics in the financial system and these LDIs took over, which had their own extraordinary momentum, at least for a couple of days. But that's my
do you think
feeling about it.
Just looking slightly bigger picture, do you think that sudden instability in the gilt market, and obviously there was the pensions issue, which was a consequence of it, but do you think it highlights or is a symptom of an underlying weakness in the UK economy, and that if we didn't have such big national debt or current account deficits or so on, that actually the market wouldn't have reacted so?
It may be that a lot of things are adding together. We're not a reserve currency.
Yeah.
The US would have more room to do these things. I imagine it may be that the overall balance sheet, although if you look at our net overseas assets, they're not, alarmingly low. There may be a number of contributory factors.
I think, if you don't want to say, we have of course seen this, seen fragility in other markets. I mean, the US Treasury market, which is one of the deepest markets in the world, of course, experienced this during the dash for cash. So it's not a uniquely British thing. I mean, I think John discussed this when he was here, John Cunliffe, that is. I mean, I think it does point to this issue, which we know we have, and we have globally, which is why it's an important issue for the Global Financial Stability Board, of, one of the things we've seen since the financial crisis, and we shouldn't be surprised at this, is that we've regulated the banking system, and we have seen a relative shift in intermediation to the non-banking system. It's quite pronounced when you look at it in global terms. And we are getting more things now, blowing up in the non-bank world. The banking world been rather more stable in that sense. We are seeing more things, whether it's crypto, whether it's LDI pensions, some issues around commodities. We are seeing this happen, and we are both globally and domestically thinking, we have to think very hard about how we survey what is a very big landscape.
Just going forwards and coming back to this, the response to the gilt market and the rise in wheels, is there a risk there now that the Bank of England has to raise interest rates up more than it otherwise would have to ensure it's got credibility in the bond market?
I mean, I think that one of the ways to judge that is to think again about the currency. The MPC, we are all focused on inflation.
Yeah.
And going right back to the beginning, we will do what is necessary to make sure that it comes back down to target, whatever that is. Now, had there been an ongoing effect on the currency, and therefore on our inflation forecast, then the result would have been a higher interest rate than would otherwise have been put in place, clearly, because that would have affected future inflation. That, as I said earlier, most of that seems to have gone. So one can't say it's affecting our decisions right now. We're sensitive to it because the inflation forecast will be sensitive to it.
So just to be absolutely explicit, so you don't think that the interest rates going forwards will be higher than they would otherwise have been as a result of this mini budget?
Well, as we sit right here, whatever time it is, 4 o'clock today, we'll see. I mean, the exchange rate does have, as Catherine said, an important bearing on our forecast. So, if that position were to change for whatever reason, then it would have bearing on future interest rates.
As it stands at the moment?
As it stands right now, we're not meeting, so I can't tell you what our next thing is.
But there is a lesson to be learned about that question with looking at what the yield curve was at the 6% peak, at the 5.25 when we had to make our forecast, at the 4.6 at the where it is, I think where it is now. So the lesson there is the market response has been to reduce the premium.
Yeah.
And so that puts us in a different position with regard to our monetary policy. Because when it was at 6% or 5.25, that's when we were looking at the deeper recession.
So don't go crazy tomorrow.
So I'll say two sort of important points with respect to that. One is that the volatility is now higher, and the fact that we've seen the exchange rate dip to such a low level does put some level of risk on that. The second component of it is it also makes it harder to actually make sense of the data and to really take stock of what's happening on the supply side, what the right rate should be. I think those things become a lot harder when you've had really volatile episodes in the middle.
I was just going to add that it's interesting to Catherine's point. I mean, there was a point, if my memory is right, around when we were at the 6.2, when the market was expecting us to raise rates by about 140 basis points, so 1.4% in one go. I mean, there was a period when they were expecting us to do an emergency meeting. Now, of course, we did raise interest rates by 75 basis points, but my view at that time, when we were really in the teeth of it, was, that level is too high. That's Catherine's point about recession. And you can't solve a fiscal issue using monetary policy in that sense. Monetary policy has its role to play, but that's going beyond it.
My last question, given what we've seen of the power of the bond markets in terms of UK domestic policy, would you like to be reincarnated as the bond market?
He doesn't want to scare
to get my head around what that would actually be.
Means you can intimidate presidents and overrule governments.
Have you ever met the bond market?
Means you can intimidate everyone. Anyway, that's all my questions. Thank you.
Thank you very much, Anthony.
At Citibank, as the chief economist there, no, I don't want to be reincarnated in the bond market.
Thank you very much. And Governor, since you mentioned crypto, and we've had this inquiry going, and there's there was this explosion last week with FTX. Can you confirm for the public that there is no systemic risk to the UK from the collapse that we've seen?
Well, the FC, I mean, it's a better question for Nicola Rathi actually than me these days. I'm a bit sort
in
of.
Terms of
but in the FPC, I can answer it from the FPC perspective, and indeed, I can give you a sense from the Global Financial Stability Board. We are doing a lot of work on it. Our view generally is that it is not currently large enough to be systemic, but it has the potential to be so, and therefore, the FSB, global FSB, that is, of which I chair one of the standing committees actually, is working very actively on crypto regulation, both in respect of stable coins and so-called unbacked. I don't certainly I don't anywhere really, actually, I should say, to be clear, because it's important to be clear on this point, detect what I would call a systemic fallout from FTX. Its activity in the UK, as far as I'm aware, is actually not very substantial. And, by the way, the FCA has refused a number of authorizations for these companies.
We still think there are constituents probably affected.
Oh, I think no. No, there is ownership of crypto in the currency in this country. No doubt. I get asked about it, particularly when I go to schools, actually, interestingly. How concentrated it is, I'm not so sure, actually, in this country. But it's not something we can be relaxed about, and I can assure you we're not relaxed about it. And by the way, of course, the legislation that's going through Parliament has a distinctive crypto
As of today,
regime.
You don't feel that this is
FTX,
systemic
I don't think
across
there's a systemic fallout from FTX in that sense, but it's something we are spending a lot of time on. I say particularly internationally, because as you probably know, I've been, I think, for at least the last 4 years, been saying, look, honestly, there is no intrinsic value in unbacked crypto.
Thank you, Governor, and thank you to the team. You've come in on a historic day, when inflation is at 11.1%, the highest for 41 years, and our constituents are all relying on you making the right monetary policy decisions to get inflation back down to your target rate and to make those decisions independently. And we understand you are not making any comments today that are relevant to tomorrow. So we appreciate you coming in on this occasion, and we'd like to thank you and the team. And order. I declare this meeting over.
Thank you.
The proceeding has ended.